Okay, so if you buy this, okay, and you want to short the market, all right, you can utilize this for the entire month, right? So you can utilize this for the entire month till the end of this expiry, which is on 17th, which is going to happen on 17th of October 2018. Okay, so what you will do is at the time of entry, okay, you might want to uh, create a position, okay, only in case of positional views, okay. You might want to take a position. So if you are going short, okay, then perhaps you will want to buy some calls. Okay. Now, if um, say for example, if you're wanting to short this crude, okay. Now, how much can crude go up? Say about say 5%, right? So how much is 5%? 5% is roughly 250 rupees. What is the price right now? Say 5200. So 5200, 250 rupees is how much? Roughly say 5500. Okay. Or 5450, 5%. It is 15 rupees. Trading at about 35 rupees here. 5% above. Okay. The current. And what is the current which is low? Is again 700 roughly, which is also roughly the same price. The combined price of these two is actually less than the price of 5100. Do you see this? Yes, no, maybe.
Yeah.
Okay, so you know that if you are going to short, you are going to short a little higher, right? Already. And if you are going
Mm.
to go long, you are going to go long a little lower, right? So if that is the case, then 70 rupees is per lot is going to be your investment roughly to protect your positions. Okay, because if we are anticipating a big gap down or a big gap up, then these prices will be drastically shooting up or down, right? Because if you look at it, currently it is giving you a premium of say 100 rupees over here at 5100. Okay, so both the levels, up as well as down, if there is a big gap in it, then it is anyways going to give you a very big this thing. However, if you are building a position and if you are leaving it, okay, in that case, if you are going long at a level, then anyways the puts are cheaper. And if you are going short, then anyways the calls would be cheaper. Okay. So that could be the correlation. Now, the second thing is that it might happen that you build a position and you leave it overnight. Okay. And there is some volatility in the international markets. And that causes something like this to happen. Say, say something like this to happen, right? And you're building the position, say here, and the very next day it is opening down, right? It's a half day, and also, you know, you don't have the option to manage the position, and it is opening down, and you could not cut your position or whatever. Okay, in that case, what you will do is, anyways, if it opens gap down, all right, if it opens gap down, because anyways they are going to take a margin and also ensure the mark to market for you. What you'll have to do is that if you see an adverse effect, this day it was up and all of a sudden it is coming down, all of a sudden, okay, what you will do is you will create a position, okay, in the, say, if you're trading October contract, you will create a position in the November contract in the opposite direction. But please remember, the cost of it is very high. Okay, so you have to bear this in mind. The cost of managing a position will always be extremely high. Cutting a position will always be a lot cheaper. But in that case, you have to book losses. Is it clear? All right. Any questions?
Not very clear, sir. Like you want us to create a calendar spread if there is opening against our position.
Hmm. Then you will say, for example, your current position is in September. Okay. Then you will have to create a new position in October in the opposite direction.
So a calendar spread you are suggesting.
Hmm. In that case, what will happen is it will lock the loss for you. Okay. What will happen is whether the price now goes up or the price goes down, it is not going to impact you. Whatever you have lost, it is going to lock it, but it is not going to book it. Okay. Then what you will have to do is, after that volatility in one direction, say that volatility gap is situation is over. Now it is quite clear to you, right? Whether it is going down or is it going up. You will cut one of the positions. Okay. You will either cut the October position or you will cut the September position. You will close down on that. That will ensure that you are not making a loss which is more than what you have made in the morning.
So rather than buying call and put overnight, it's
Hmm.
better to lock using a calendar spread.
Huh. You can do that. The only thing is that the cost is a concern. Okay. Now, say for
That's
example, if you are paying say 60,000 margin for say this one lot, then you'll also have to pay another 60,000 to lock it overnight.
But for normal index stuff like this, for spreads, the margin would be less, right? Not same with commodities.
No, no, no. No, margin is less in commodities. The margin is not very high. But the thing is that the mark to market will not matter you, because whatever falls here, it gains there. Okay. So that is not going to matter you. But the problem is that if the trade starts working in your direction, then you'll get nothing. Right? Say you are in a long position primarily and you lock it overnight. Okay. Next day it gaps up 50 points. Now, which means that the trade is working in your direction, right? Then you are not gaining anything, right? So that thing also is there. Okay. Plus, in case of say vis-a-vis, if you compare it to your cash markets, in cash what happens is once you buy something, it becomes an asset. In futures, if you buy or sell something, it becomes a liability. Do you know this? Any one of you? Okay. When you buy a share in the cash market, it is recorded as an asset in your balance sheet. But if you buy something in futures market, then it is treated as a cost, as a liability. Okay. Till the time you don't make a profit or whatever, okay, it is anyways a liability. That is the reason you'll always have to be worried about the mark to markets. Okay? Because futures trading is liability trading. Cash market trading is asset trading. Okay? Any other question? Okay. We are going to discuss on the long-term trends of any commodity. So we will do it for crude oil on day after tomorrow class. Okay, in which we will try to see that when you keep three contracts side by side, it is going to give you a fair idea that is the price of the futures contract, okay, is going to increase over the time or most likely is going to decrease over the time. Okay, so it might not be able to give you clean price levels like we found out levels and all that, okay, but it is going to give you an estimate of whether the futures contracts are going to appreciate in the next month or so, month or 2 months, or is it going to depreciate? What is the likelihood? Okay, so this is what we will do day after tomorrow. So we'll take a few months of example. The only thing is that we cannot look at charts because the charts are lost for the previous months. All right. So any questions before we close?
Do we have any significance of the spot prices here, or
No, nothing.
they're not considering them?
Useless. Actually, you need the spot price of Brent or NYMEX, right? Now, this market is more closer to NYMEX than to Brent because Brent is more UK based, NYMEX is US based, and this MCX market is sensitive to primarily the US based. So you actually need the spot price of what is the current spot price, but the problem is that that spot price is not available. You don't have it. Okay. So whatever you see here, that is nonsense data. That has no relevance.
Sir, if we in the contract, this thing, no, bar copy, if we analyze that in a day it has closed above the high and the open interest has also increased. See, so that thing happened. So what is the level that we should target for, sir? To is that the high of the day which close, which
No,
that thing closed?
what I basically do is in my this thing. say for example, let's look at the Excel sheet first. say on this day, it told us there's a bullish indication, right? So,
Yeah.
so this was the first day. It was telling us that okay, there is bullishness. So bullishness means it should go up, right? So the price should
Yeah.
follow on the upside. So this date is 22nd of August, right? Now, if I look
Yeah.
at the data, see 22nd of August is here, right? So 21st, this is 22nd. Now say this is 23rd, 24th, 25th. This is the first time after this it formed a level. Correct? This is the first time it formed a level.
Yeah.
Okay. So this went up and it came down. Now it means that now it should either start breaking the lows or should breaking the highs. Correct? Now next day is anyways inventory. So you will not trade it, right? Because you'll have to see is it breaking the high or is it breaking the low. Now see, it is breaking the high. If you look at it, right? Okay. Now, if it is breaking the high, in case of commodity, this crude oil, it is very sensitive to the highs and lows. Okay. You will find this. So this is the high, right? So this place is the high. So more or less, this is the place where you want to place your trades.
So that means after getting a bullish indications in this bow copy, we should wait for the establishment of a level, right?
Of a level, right?
Of a level, and the next thing is it should break that level, and if that is not an inventory day, we can take that level itself for trading, right? We didn't take that level because it was an inventory day, right? On 29.
Plus
Yeah.
on the important inventory day, it again gave a bullish this thing.
Bullish this thing. Yeah, correct.
Okay, the same thing can happen. It can give a bearish setup. It can also give a bearish setup, but it depends, right? That how is crude doing? Is it bullish? Is it bearish, or what? So ideally, if you will look at the crude oil, okay, but day after tomorrow class, we will see that what was the October price, okay, for the previous month. What was the September price for the previous month, and we will see that how is it closing on a monthly basis. So is it closing bullish or is it closing bearish? Because if it is closing bullish and the level is shifting up, then most likely it is going to go up. That is what we do in equities also. Okay. So from that perspective, what you call the overall trend will also matter. Okay. That is it sideways? Is it overall bullish or is it overall bearish? Okay. If you will look at the charts of last year, this time, this is what September, right?
Yeah.
Last year September, you will find price of 2400, 2300. The same time, almost. It was roughly $30, no? That time. Somewhere in between $30 to $40. Right now it is in between $70 to $80, right? So the price is double. Okay, but the thing in the futures is that it gets slightly difficult. One, okay, because it is overall what it is overall futures, right? So there is no cash at all in this. It is all futures contract. So point number one is that. Point number two is the liquidity the only instrument in case of MCX or commodities is the futures contract. There is no other supporting data. If you look at this options chain, it has just come. It is not even 6 months old, right? And for crude oil, it is not even 3 months old. I'm talking about gold, okay? Not even 6 months old. So there is no supporting data. Like in case of equity, it is so matured. There is so many data points which is available. Okay. So you can actually mix and match all of them and you can utilize them. But in case of commodities, it's a very weak market otherwise. If you look at it, like weak market in the sense data perspective, it is weak. Okay. So that's it. Now they also have index data, okay, which we will look at day after tomorrow in the MCX database. Okay, the way we do it in equities, that we first look at this, we first try to spot the sector, right? That which sector is doing good. So the same way, we will try to see that this month should I focus more on energy or on base metals or on precious metals or which one? Okay, and then we will try to pick up something. Now, please remember that within energy there are only 3 commodities. One is crude, second is natural gas, and the third is mentha oil. Right? There's no fourth one. So we'll have to live with that. But the best of the commodities that is traded and loved, most of the traders who work in, one is crude oil, second is gold, third is silver. These are the 3. These are the most loved because the most of the money is made in only these 3.
So what was the third?
Silver. So it is gold, silver,